Hello friends. Welcome to our weekly update on tax and corporate laws for the week ending 16th February 2025. This week, we have some crucial developments in income tax, GST, and PMLA laws that every professional and taxpayer should be aware of. Let's dive into the key updates. Starting with income tax, the Bombay High Court delivered an important ruling in the case of Hiralal H. Malu vs. Deputy Director of Income Tax investigation. The case revolved around the seizure of jewelry during an income tax search. After the taxpayer's death, the legal heir requested the tax department to return the jewelry, but the department and the bank started blaming each other for its loss. The court ruled that the matter should be investigated by the CBDT or the chairperson and managing director of the nationalized bank, and they must take immediate steps to ensure that the jewelry is returned to the rightful legal heir. The court also emphasized that banks cannot escape liability in such cases, and tax authorities should act responsibly, remembering that they are merely custodians, not owners of seized assets. In another significant case, the Rajasthan High Court, in Principal Commissioner of Income Tax vs. Excess Air Services P. Limited, ruled on the applicability of Section 68 regarding unexplained cash credits. The tax department had added certain amounts to the company's income, claiming that shares were issued to an individual in lieu of goodwill without any actual monetary consideration. The court held that since the transaction did not involve any real cash receipt, Section 68 was not applicable, and the addition made by the assessing officer was unjustified. This ruling provides clarity on share allotments made in exchange for non-cash considerations. Another critical judgment came from the Bombay High Court in the case of Shrenik Kumar N. Baldota vs. Deputy Commissioner of Income Tax. The court quashed a reassessment notice issued under Section 148, ruling that since the taxpayer had fully disclosed all material facts during the original assessment, reopening the case was illegal and arbitrary. This decision reinforces the principle that reassessment cannot be initiated without valid reasons, especially when all relevant documents have already been submitted during the regular assessment process. The Kolkata Tribunal, in the case of Commissioner of Income Tax, Exemptions vs. Indira Trust, clarified the registration process for charitable institutions under Section 12A. The Commissioner, Exemptions, had wrongly denied final registration, calling it premature, despite the fact that the CBDT Circular No. 11 of 2022 clearly stated that provisional registration under Section 12A, 1, ACI, automatically becomes a regular registration under Section 12AB, 1A. The tribunal ruled that the trust was not required to apply again for final registration, making compliance easier for charitable organizations. Another important ruling came from the Madras High Court in Srinivasan Jayaprakasham vs. CBDT, regarding the Vivad Se Vishwas Scheme. The court clarified that even taxpayers who intend to challenge an income tax order but have not yet filed an appeal are still eligible for the scheme, as long as the appeal filing deadline has not expired. This provides a wider window for taxpayers looking to resolve disputes under the scheme. Now, moving to the Goods and Services Tax (GST) laws, the Bombay High Court made a crucial observation regarding arrest in GST cases. The court ruled that arresting a taxpayer without allowing them to comply with a summons could amount to interference with the administration of justice and even contempt of court. It further directed that the revenue officer be issued a notice for potential misuse of power. The Guwahati High Court also passed an important ruling in a case involving GST evasion through false input tax credit (ITC) claims. The court granted interim bail to the accused, emphasizing that since the investigation was still ongoing and no final determination of tax liability had been made, the taxpayer could not be denied bail purely based on suspicion. Now, shifting focus to the Prevention of Money Laundering Act (PMLA), the Supreme Court of India, in Union of India vs. Kanhaiya Prasad, held that courts must strictly consider the conditions under Section 45 of PMLA before granting bail in money laundering cases. The court warned against a casual approach in granting bail, emphasizing that serious economic offences require courts to carefully examine the gravity of the crime before passing bail orders. The New Delhi Tribunal, in Charanjit Singh Gandhi vs. Joint Director, Directorate of Enforcement, ruled that even if criminal prosecution under PMLA is still pending, attached properties can remain seized if there is evidence that the proceeds of crime have been transferred. This means that as long as there is proof that illegal money has moved from one entity to another, authorities can continue to hold and investigate the attached properties. Finally, the adjudicating authorities' powers under Section 8(1) of PMLA were clarified. The tribunal held that the authority is not required to record reasons before proceeding with the case. If a complaint is filed by the initial authority under Section 5(5), the adjudicating authority can move forward based on its own subjective satisfaction, without providing detailed justifications. This ensures faster decision-making in PMLA cases but also means that businesses and individuals under investigation must be prepared to comply with proceedings swiftly. That's all for this week's update on tax and corporate laws. Stay informed, stay compliant, and keep following our updates for the latest legal and financial news. Don't forget to like, share, and subscribe to stay ahead of all important legal changes. See you in the next update.